Hi there, everyone. Rob McGregor here. It's the 21st of December as I record this. I think this is our third year of On Track. So I just want to take the time before I dive into it to wish everyone a very Merry Christmas. It's been another crazy year, certainly not the years that were predicted. I'm going to talk a lot about predictions during this. But it's safe to say it's been good it's been better for lots of us here on the Sunshine Coast, lots of our clients in Sydney and Melbourne. I know it was a much tougher year, but I just want to take the time to say thank you for your support of our business. We really take looking after you seriously, and I want to wish you all the best for Christmas, New Year, and I think the world should be in a very interesting place in 2022, and let's get into it. So yeah, this is our I call it the November edition, but it's live, up to date news up to 21st December. It's just the numbers that come out to the end of November. That's performance numbers, but it's also numbers that come out from the RBA and other economic data that we don't get till midway through the month, which is one of the reasons we record this more towards the end of the month. Firstly, this is for clients of McGregor Wealth Management, particularly those that use the CARE methodology and CARE portfolios. For anyone else watching and listening, I hope you enjoy it, hope you get stuff out of it, but you shouldn't act on anything we talk about here without getting advice or seeking more information to make sure it's applicable to your own circumstances. Today I'm going to have a look at the economic news, and it continues to be dominated by COVID, in particular Omicron. Bit of news about inflation. China zips in and out. They're the three hot topics, it seems, on everything. I'm going to put it into context about what the market's been doing, the key markets, have a look at the returns on the portfolio that continue to be good. Talk a bit about COVID and the latest numbers and try and put them into a bit of context. And I'm going to continue from last time looking at some of the behavioral biases, which are some of the biggest impacts on investor performance in the long run. And today I'm going to have a look at currency and the impact that has on portfolios. And as always, try and put it all in perspective. So let's have a look at the news. And yeah, Omicron, I still continue not to be able to say it. You'll see a chart there at the top here, which is the world cases of Omicron. And this shows the alpha, the beta, the delta, and the Omicron. And you'll see as one variant escalates, as a new variant escalates, the previous one declines. We've seen that all the way through, and we're just starting to see that now with Omicron declining, Omicron increasing and starting to knock down the Delta virus. That appears like that's going to be a good thing. It appears like Omicron's going to be a weaker version of COVID. Everyone keeps saying it's too early to tell. They've been saying that now for 6 weeks, but it looks like it is. I think they're just being overly cautious. But anyway, I'm not an epidemiologist. I just watch the news and interpret it for you guys. But yeah, fingers crossed that it is a weaker version. Australian vaccination rates are now up amongst the highest in the world. That means we're open as a country pretty much, except for WA, and they've indicated they're opening in February. Our neighbours in New Zealand look like they'll be March. So they will be two of the slowest countries in the world. Not that WA is a country, it's just been behaving like one. So as we're opening up, we're sensing a lot of nervous moments. We're seeing cases increase, and that's why I'm going to talk a bit about what we should be focusing on. It's quite disappointing continuing to watch the media, and they still love using cases as their headline. They're not reporting the context of how severe the people catching COVID are getting it, and it appears that it's milder. They're not reporting, except as you go down further, on the hospitalizations and the people in intensive care and the death rate overall, which is generally improving and better. You'll see in the table in the middle here, Australia shows up at 79% of people 1 dose, 76% of people 2 doses, 4% booster shots. So while we're leading the world, or up there with 2 doses, not as high, by the way, as say Singapore at 87. We're just getting started on our boosters, and I know I'm due for mine in January, and I'm sure a lot of you guys are either about to be boosted or soon to be boosted, and that'll become a key measurement because it does appear the boosters are effective, and it does appear the initial vaccine wanes over time. We're still getting inflation numbers. You'll see down the bottom here, US inflation is pushing up towards 7% when measured. You'll see, though, it dropped severely during COVID. So all that gap during COVID is effectively catching up here. We won't know whether this is transitory or trend for another 6 months or so, and it may be a bit of both. We're not particularly worried about it. The media is likely to harp about it. If you want more information, go back to our last two videos, and I talk more about it there. I'm going to leave it alone today. I'm sick of the media talking about it as if it's the most important thing. And while it's important, it's not the most important thing. Our numbers in Australia are steady. We're still sitting at 3% inflation. We're waiting to see whether that stays up there. And you see not much change when you look down the right-hand side here. Cash rate's still low. The 10-year government bond yield actually dropped during the last month, and that was because fears that Omicron was going to slow down recoveries around the world. So that led to interest rates dropping. So they're still incredibly low. Aussie dollar still lingering a bit lower. I'm going to dive into currency today a little bit more. But inflation low, mortgage rates haven't really changed much. The fixed rates have gone up a little bit. But important to note, we're still at emergency low interest rates that will revert back to some sense of pre-COVID normal somewhere in the next 6 to 18 months. What happens from there will depend on so much about how this recovery plays out, and any predictions to try and predict what interest rates will be 5 years out are fraught with the usual difficulties of predictions. And I'm going to say it a few times during today's video that no one that makes predictions makes money in investing. There is no fund manager that makes their money from predicting. They all make their money from principles and applying long-term principles, because it's absolutely impossible to predict these things. A couple of little quirks there. 4 days to Christmas as I record this, and we're 2 up in the Ashes. So I know a lot of you are keen cricket fans. It would be nice to see a bit of competition, I think, but it's always nice to beat England, but it seems to be the way for the last 20 or 30 years. Let's get into some more numbers. The portfolio returns continue to be good. Look at the 5-year numbers, the 3-year numbers, the 1-year numbers. The 1-year numbers are coming down as we get further away from COVID, but it's the 3 and the 5 that are our important ones. The purpose of your portfolios is to provide for your well-being over time. It allows us to plan your future, and that's why these numbers are so important. And the process we use is pretty consistent at delivering performance above the averages, consistent with our targets that we use in the planning. I won't dwell on any of that except to say continue to be good. And you'll see that in the numbers here as in the handouts. Our market assessment framework, the wall of worry. There's no doubt we are still in the wall of worry. As I keep saying, I've never seen so many people worried about share markets, worried about this. And I will point out again, the time of the most danger is when people stop worrying, when people just think this time it's different. It's easy to make money. We've seen that in things like crypto. We're seeing it a little bit in property at the moment. I'll touch on that again. We're certainly not seeing it in the share market. We're actually seeing people worry, which tells me the chances of a major downturn are actually pretty slim. There's always the chance of corrections, particularly in that 5 to 10% range. They're normal every year. We're in the middle of one at the moment. You'll see when we get to the numbers where we're down a little bit. We've been sideways for about 6 months. That's extremely healthy. A very healthy correction after running hard for nearly 11 months straight up. All of that cycle driven by the pendulum that swings between fear and greed. But the other way of saying greed is fear of missing out. So it's fear versus fear. One's fear of losing your money. One's fear of not making as much as your neighbor, your brother-in-law, your sister, or whoever. We've got our market assessment at just over fair value at the moment. And, but we don't, we're very comfortable with people investing at the moment at these levels. We're very comfortable with dollar cost averaging. And certainly not in the concerning areas, which is when it starts to get into the orange and the red here. Two more investor behaviours I want to highlight today, and these are the things that cause most investors to get less return than their investments, which I talk about a lot. It's because of their behaviour. They make bad decisions at the wrong time, and they zig when they should zag when they should zig, and it's caused by all these biases. Two more today I'll go into: hindsight bias. And it's the definition here. It's a psychological phenomenon that allows people to convince themselves that after an event they accurately predicted it before it happened, and this can lead people to conclude that they can actually accurately predict other events. So we're all experts after the event, but no one predicts these things. No one predicts these things before they happen. And the people that make the most predictions almost never make money from managing money. They tend to be media people that are selling doom and gloom, and other types of stuff that they're selling. Overconfidence bias. And that's a tendency for people to overestimate their abilities. They can think they're above average. It's funny, 66% of people think they're above average drivers. That, of course, can't be the case, but it gets worse the smarter people are. Investment managers, 93% of them think that they're above average in their abilities, and the other 7% think they're average. So no one thinks they're below average, and obviously by definition 50% of people must be below average. And university professors, even worse, 97% think that they're above average compared to their peers. So that overconfidence leads people to take on more risk, particularly around investing, and that can lead to poor outcomes. And all these biases come together in our thing here about mess it up, how people mess it up through the media. And you've heard me time and time again talking about that. COVID's been the biggest example of the media driving everyone's focus and keeping most people scared. And it's one of the reasons we do these things, is to put in context what comes out of the media. And once again, we've never, ever focused on something, a single issue obsession like we have with COVID, certainly not in my lifetime. And the others there I won't go into today. So talk about perspective and focus. Once again, I said the media keeps focusing on headline cases, and I think that's unfortunate, because they should be focusing on, they can report the cases, but they're not looking at the severity, and they're not looking at the other things like hospitalizations. On the left-hand side here are some numbers from Europe, and while you can see the dark blue line, new cases, is soaring. The red line, which is deaths, is going sideways, as is hospitalizations. UK down the bottom, the same sort of thing. And we get no perspective and context on how many people are dying of COVID compared to everything else. And you'll see on the right-hand side here, I'll try and put that into context, but of the 44,000 deaths that registered and this is English data, registered in September 2021, 6.6% were due to COVID. And that's, I think it's 7.7% if it's all deaths that involved COVID. And there's a bit of controversy on how that's defined. But even so, it's 5% of deaths. That means, 6%, that means nearly 20 times as many people died of other causes. So when we look at the deaths rates, and sorry, I'll just go back up to that chart, you can see the deaths from COVID in this wave, and you'll see that the 1, 2, third wave are way down on where they were in the previous waves. And it actually has happened while deaths in England have gone up in general. You'll see here 20 years worth of mortality rates. This is how many people die per 100,000 people on the top right. And you can see that in any 1 year, that literally roughly 800 to 1,200 people die, depending on whether you're male or female, depending on the age groups, but this is standardized. So the COVID death's now about 5% of that, but unfortunately death is a normal part of life. And we're not getting a focus on other things, and there's plenty of media about this as well. Don't get me wrong, the current COVID threat is real, and there will be some people that suffer from it, but for those who are vaccinated, the science is telling us we're less likely to catch it, we're less likely to spread it, we're less likely to get sick, we're less likely to be hospitalized. The percentages are dropping, and that's why we're getting the urge to get another dose, get the booster jabs. And hopefully what we'll see in the next few months is some science coming about the lesser severity of Omicron, and hopefully it whimpers out into a kind of mild flu / cold. And that's the beginning of the end of COVID. A colleague of mine mentioned to me during the week that a friend of his is a scientific researcher, and he told him at the start of this pandemic that pandemics go for 4 years, which means we're halfway through it, but I'm assuming the second half is as it slowly declines, but it's going to be real for the next couple of years, and then hopefully we forget about it completely. Let's move on from COVID, and I want to talk about currency and just some real basics here. So we all have investments that are overseas, and most of it is in US dollars. And I'm going to go through some of those percentages when I go through each sector today. But effectively, if you own shares in the US, you own them in US dollars. So every time the Aussie dollar goes up, so right now the Aussie dollar is at 71 cents. So if you see the Aussie dollar go from 71 cents to 75 cents, that means you make less money from your international shares than you would otherwise. The opposite, of course, when the Aussie dollar goes down, you make more money than you otherwise would. So that means and this impact has helped Australian investors throughout. It drives one of our reasons for diversification. And you'll see here I've highlighted two events. So during the GFC, when the share markets dropped 50%, the Aussie dollar went from $1 down to 65 cents. Now, what that meant was for all the shares we own in the US, they didn't go down as much for us. So even though they went down 50% in the US, the equivalent was only about 25% when you look through the currency for us. The same in COVID, the Aussie dollar was cruising along, not right up there, but about where it is now. And then COVID came along, it dropped down to 55 cents. That cushioned the impact. Now, the reverse is true. When the Aussie dollar rises, that puts a handbrake on returns of US dollars. But it often helps us to balance out. We've seen this in the last 3 months. The Australian share market's been going sideways, but our dollars dropped back, and that's meant that our international investments have done well. So the portfolios are doing better than the Australian share market because of that Aussie dollar impact. And I'll carry that through our conversations as I go through the markets. I'm going to skip that one. That was from last month. I'm going to skip the pillars, but yeah, we've been through this. I'll go through this when I do my annual update early in the year on our investment process, etc. But let's have a look at Aussie shares for the month. So the ASX 200 closed at 7256. We're about exactly there today, I think, just listening. And you can see we go back to June. So it's effectively been flat since June. Now, when I say flat, you've had dividends during that time, so a little bit of a return. And when you look to the 5-year, you can see that nice increase. So, and right now we're still sitting on 1-year returns of 16% from coming out of COVID, but pretty flat for the last 6 months. And you'll see the top 10 there again. One change in the top 10 in the Australian share market. Woolworths dropped out and Goodman Group jumped in, which was interesting. Bit of a assessment that Woolies might not make as much as they did pre-pandemic. Once again, be careful of predictions. Woolies has been predicted to be make less money for years and years, while it's gone from about $5 to $30 or $40. So let's go on to our international shares. So this is US shares. And this is where I'm going to talk about currency as well. So you can see here that while 6 months back in Aussie share markets, we're flat, but we're actually up in US shares. And that's partly because of the dollar. The Aussie dollar has dropped from about 75 cents down to about 71 cents. So that's contributed to that return in the short run. And we're also seeing it in the long run. And what I've done here to show you this illustration, so the table down the bottom is the S&P 500. Now, this is your view from the US. So if you were sitting in the US and you'd invested in the US share market in the last 10 years, you would have enjoyed a 16% return. Now, while that's a good return, it's not crazy spectacular. US shares have averaged 10 to 12% in the long run. So it's above average, but not crazily so. Whereas in Australia, we've got a 20% return in the last 10 years from US shares. And that's because the US dollar, we dropped at the start of that 10-year period, we're about $1. We're now at 70 cents. So we've had that extra return from the falling Aussie dollar. As we come back into, say, the three-year returns are almost identical at about 21%. And that's because the Aussie US has been going sideways, same for the 5-year. So we can see a long-term benefit of the Aussie dollar falling, a short-term benefit the last few months of the Aussie dollar falling, not much difference in the long run. But this is good for our diversification once again. The same here with US small caps. So your small caps, another good month, a fantastic year at 35%. And in the States, that they would have got this, once again, bottom left here, I've shown the return of US investors in US small caps. So it's exactly the same portfolio, but it's just looking at it from a US dollar cap compared to Aussie dollar. So if you're sitting in the US, your 10-year return on small caps has been 14%. But us in Australia, investing in US shares, have had an 18% return because the Aussie dollar's dropped. Not much difference in the shorter term, a little bit in the 1 year. Once again, the 3 and the 5, relatively close, but a great performer, a great contributor to the portfolios, and we expect they still will be. Global leaders. So in the active portfolio, we hold a stock called IOO. It's the top 100 companies in the world. And what I've shown down the bottom left here is the percentage of the top 100 companies in the world in this portfolio in different currencies. So 73% of that fund is in United States companies, so therefore in US dollars. The rest of it spread out amongst UK, Switzerland, France, Japan, Germany, Korea. China doesn't show up there, which is important in the next slide that I show you. So once again, we see a bit of that currency impact again over 10 years. If you're sitting in the US, your return on this fund is just about 13%, 12.72. In Australia, it's 16.89. So these international shares have done extremely well over 10 years, mainly because of the drop early on, about 8 years ago from $1 back into the mid-70s. In the 1, 3, and 5, it's less different. It's different in the 1 year, but in the 3 and the 5, almost the same. And it's different in the 1 year because we've seen a weakness in the Aussie dollar over the last year as well. So just a different focus this month, having a look at the impact of currency. Emerging markets, and you'll see the currency makeup down the bottom here. So for this fund, which is in both the core portfolios and the active portfolios, IAM, and it's been not a fantastic performer, but that's diversification. We expect that emerging markets will perform strongly in the next few years as they come back to their averages. But part of the reason it hasn't performed as well is 31%, nearly 32% of that fund is in China, Taiwan, Korea, and they're all been impacted by stuff happening in China. And you'll see that with the sideways, emerging markets up 5% for the year. Some of that's dividend, but it's fairly much been sideways. As once again, though, we do expect emerging markets to be an important contributor over the long run. Gold, as always, gold's not doing much at the moment. It's had a sideways year. You can see they're completely flat for the year. I think it's up 0.3%. It's the canary in the coal mine though, so we're happy to see it flat, particularly if everything else is up, which is often the way with gold. And we will continue to hold it in the portfolio as a bit of a hedge against other bad stuff happening. Let's have a look at property, and a sea of green, except for a little bit of red around Darwin. If we look at the 12 months performance, and we looked for the top to bottom, so you'll see Sydney 25%, Brisbane 25%, Canberra 24% leading the way. At the bottom end, Perth only 14%, still very good numbers. But as I talked about last month, Perth's coming off the back of 10 to 12 years of property prices not rising there and just starting to come up as well. An extremely good year. It's going to be fascinating to see where this goes. Our framework here, similar to the wall of worry, but different, is that property cycles go through the boom, the bust, and the boring. And I've got some extracts out of the Herentide White monthly report. Makes for good Christmas reading if anyone wants to read 141 pages on what's happening in property around Australia. But a few snippets, particularly out of my home turf, the Sunshine Coast. And we set the record for a price in Queensland down the bottom there. 17 Webb Road, Sunshine Beach is reportedly under contract for $34 million, which is quite staggering. That'll break the record for Queensland. There's still bigger prices than that in Sydney and Melbourne, but that's more than any Brisbane price. And there was a unit in Hastings Street at Unit 5 at 81 Hastings Street, which is under contract for $16 million. So that works out at a cost of $57,000 per square metre, living and outdoor. And a good example of the boom, there was a house at 3 Mar Terrace, Sunshine Beach, which sold in March 2020 for $2.1 million and was recently purchased for $4.4 million, more than double, 110% increase within the same year. So the Sunshine Coast, we're seeing up 50%, more in some locations like Sunshine Beach. So we're certainly, when we look at that context of boom bust boring, we're certainly in the boom. And we know that eventually, can't tell you when, but eventually and inevitably after a boom comes a bust, or at least a flattening out or a slowdown or a long period of sideways, depending on the markets. And certainly on the Sunshine Coast, we think we're towards the top of that hill. I can't tell you when, and my predictions are no better or worse than anyone else's. But we would point out, be careful around debt. Property, there's no problem holding lots of property, but borrowing too much at a time where the market's booming is something you've got to be careful of, and needs to be part of a carefully thought out plan with plenty of capacity. I left this in from last month just to reiterate that all the markets are running differently. This goes back to 2011, and you can see the difference between Sydney at the top and Perth and Darwin at the bottom. The markets, different cycles for different places, and certainly Sydney, Hobart, and Melbourne have run hard. We typically know that this reverts to the averages over time. So you're more likely to get growth in places like Brisbane, Adelaide, and Perth at the moment. And that is where we're kind of steering our younger clients who are borrowing for the long term. And we're being more careful than normal just because of the maturity of the property cycle. The Heron Todd Property Clock, as I said, we get that from their free report that's available online. It's quite an extensive report this month for Christmas reading, but the Property Clock continues to show everything rising. This is not predictive, it just tells us what's actually happening, and everything actually rising with nothing falling. Quite staggering. When that stops, it'll be fascinating. We've seen the mainstream forecasters and the economists from the banks predict 3 to 10% growth in property next year, followed by a 10% decline thereafter. As I said, predictions of that accuracy are crazy. Not one person predicted the boom we had this year to the extent of it. And Heron Todd White were quite honest in their annual assessment, what they were predicting this time last year. Some of it happened, but no one predicted 50% rises and things like that in premium lifestyle places. And it's going to be absolutely fascinating to see what happens to property. It is driven by population. We will get, as the borders open, more people coming in, both from outside, but within Australia, we're going to see interstate immigration driving some of that property prices as well. Interesting to watch, but a market to be careful in just because of its maturity. I'm going to wrap that up. Thank you for listening. The end punchline here, but you've got good portfolios designed to meet your plan, which incorporates your goals and the boring old principles of diversification, asset allocation, liquidity, keep us on the straight and narrow when it comes to our planning. Thank you again for your custom over the last 12 months, and for those that listen all the way through. We get really good feedback. We do appreciate it. I'm always open to topics you want me to dive deeper on. I'm conscious of not being too long-winded in those things, but also diving a bit deeper for some people as we go through things. Once again, have a great Christmas. Look forward to catching up with you in the new year. And we will talk soon. And have a great 22. Rob McGregor signing out for 2021.